a soft landing is possible. And Alex, the bears point, of course, to the inverted yield curve and say that it is rarely wrong in terms of predicting a recession. Now, you've brought us a graph here that will give viewers a look at. Now, tell us what the white line is measuring here.
Yeah, so this is the spread between the 2-year bond yields in the United States and the 10-year. So this is generally the one people point to when they're saying an inverted yield curve predicts a recession. You can see in the horizontal gray areas, that signifies when a recession did occur in the United States.
And that line, and that's when the line is high, indicating a significant spread between the 10 and the 2.
Correct.
With the 10 being lower than the 2, correct?
So when it's lower on that graph, the 10 is lower than the 2.
Right.
When it's higher on that graph, the 10 is higher than the 2.
Okay.
So usually the yield curve increases where longer-term yields are higher than lower-term yields, near-term yields. So as you can see, and this is what bears will point to, that's just about all the time. And if you pick, sort of a timeline from the 1980s to today, every single time the yield curve has inverted, a recession has followed. But if you do go back a little farther, and this was a little bit before my time, but going into the 60s, there was a period when the yield curve did invert and a recession did not follow. It's important to point out that an inverted yield curve does not cause a recession. It is people investing in the fixed income markets that are anticipating a recession.
Right.
But it is not 100% correlated with a recession.
Okay, and you believe that we are likely now in the rare circumstance of the yield curve forecasting a recession that may not arrive.
So it is possible. If we look at sort of what's caused this slowdown, it was the pandemic. And never before has society around the world gone through a pandemic like we did, with the lockdowns, with supply chains shutting down, completely uncharted territory for people, but also for monetary policy for central banks around the world. So to use the old playbook verbatim and saying that's what we should do, and the same outcomes are going to happen versus previous recessions, I think that is not necessarily the way that you should predict what's going to happen here. So what is different happening this time? So even though the Fed is raising rates, and traditionally that has led to some sort of slowdowns, perhaps a recession, this time supply chains are getting better alongside raising rates. So more supply is getting into the economy. Previous times that would have been happening. Supply chains were already running full out. More supply could not be added. So just simply cooling off demand and causing a slowdown that way is what rising rates did. I think that is one of the potential reasons why perhaps we won't get a recession this time around, is because of those supply chain improvements.
How about these very tight labor markets? How do they fit into this?
Yeah, so we've barely seen any cracks in the labor markets. We did get a jobs report a week and a half ago in the United States that did come in a little bit below consensus estimates, but still very strong. They are slowing down from their highs, and we are starting to see some very small cracks in the job openings as well too. But again, remaining still, close to 200,000 jobs are being added per month, still looking very, very strong. So if the Fed can find a sweet spot of continuing to bring down inflation like it has, while the jobs numbers stay up as close to where they are now, that's the ingredients for a soft landing.
Okay, that's Alexander McDonald telling us again he thinks a soft landing is possible, perhaps likely.